Money is more than numbers. It is trust, stability, and the promise of tomorrow. In Argentina, that promise has been torn apart again and again. The peso, once introduced with hope, has become a currency few dare to save. Every decade brings a new, final solution. Every solution collapses under the same burdens: debt, deficits, and distrust. For Argentines, money is not a tool for building the future. It is a race to survive today. In 2023, inflation surged to 142%. By 2024, more than half of the population lived in poverty. Behind these statistics lies a nation trapped in cycles of despair. This is not only a story of inflation. It is a story of structures, choices, and people forced to adapt when money breaks. In 1992, Argentina introduced the peso convertible. 1 peso equaled $1. It was the boldest attempt to bury decades of hyperinflation. For a time, the dream worked. Inflation dropped to single digits. Shops displayed stable prices. Families dared to save again. But the peg depended on constant inflows of dollars. When global commodity prices for soy and beef fell in the late 1990s, reserves evaporated. External borrowing filled the gap, but debt soon became unmanageable. The dollar anchor was a facade. Beneath it, fiscal deficits widened and competitiveness eroded. By 2001, the illusion was unsustainable. When money collapses, it leaves scars beyond economics. It reaches kitchens, rent contracts, and pharmacies. It decides whether a paycheck lasts a month or a single day. In 2001, the government froze deposits in the Corralito. Citizens lined up outside banks, shouting for their own savings. Some watched their life savings vanish with a single decree. The consequences were devastating. GDP shrank 11% in 2002. Unemployment soared past 20%. Middle-class families fell into poverty almost overnight. By 2024, the crisis was still alive. Over 50% of Argentines lived below the poverty line. Money, once a promise of stability, had become a symbol of betrayal. Argentina's problems go beyond mismanagement. They are structural, deeply embedded in its economic model. Commodity dependence is the first fault line. Exports of soy, beef, and wheat fund state revenues. A drought or a price dip in Chicago can destabilize the budget in Buenos Aires. Debt and the IMF are the second. Loans often came with strict conditions: subsidy cuts, privatizations, austerity packages. These measures stabilized numbers, but fueled protests and social unrest. Chronic dollar shortage is the third. The country needs dollars to pay debts and import essentials, but exports rarely generate enough. And finally, political cycles. Populist spending followed by IMF austerity. Each swing erodes trust further, trapping Argentina in crisis mode. By December 2001, Argentina hit the wall. The Corralito froze deposits. For millions, savings became a memory. Protests erupted nationwide. Supermarkets looted. Banks burned. Within weeks, 5 presidents resigned in succession. Faith in the political system collapsed as fast as the peso itself. The economy contracted brutally. Debt defaulted. Dollar debts were forcibly pesified, often at unfair rates. The Corralito remains etched into Argentine memory, a reminder that when money fails, institutions fail with it. After 2002, leaders tried new measures: capital controls, restrictions on dollar purchases, subsidies for fuel and food. Each reform bought time. None solved the underlying weaknesses. Fiscal deficits persisted. Dollar scarcity deepened. By the 2010s, black market exchanges, the cuevas, thrived. Citizens sought dollars as a lifeline against inflation. Confidence in the peso remained absent. Society adapted creatively. Provinces issued quasi-currencies to keep local trade alive. Neighborhood cooperatives organized barter markets and mutual aid. In many ways, resilience from below, not policy from above, kept Argentina afloat. In 2023, Javier Milei rose on promises of radical change. His boldest idea: dollarize Argentina, scrapping the peso altogether. Supporters argue it could end chronic inflation instantly. A dollar-based system might restore credibility and stop peso depreciation. Critics warn Argentina lacks reserves to dollarize. Without its own currency, it would lose flexibility in crises. Dollarization could also worsen inequality, hitting workers hardest. Other nations offer lessons. Ecuador dollarized in 2000. Inflation vanished, but growth slowed. Brazil's Plano Real in 1994 combined fiscal reform with a temporary anchor, and succeeded. Chile in the 1980s diversified exports and strengthened institutions. South Korea after 1997 used debt restructuring and industrial policy to rebound. Argentina's choice is difficult, and no option comes without pain. Argentina's peso collapse is a mirror of its deeper struggles. But history shows recovery is possible if the right choices are made. Fiscal reform is unavoidable. This means cutting inefficient subsidies, broadening the tax base, and fighting corruption. Diversification is essential. Beyond soy and beef, Argentina could invest in renewable energy, lithium mining and tech sectors. Sectors with global demand that could reduce vulnerability. Debt renegotiation is critical. Aligning with creditors while protecting growth is complex, but necessary. South Korea's post-1997 strategy shows it can be done. Institutional trust is the foundation, strengthening the independence of the central bank, publishing transparent budgets, enforcing contracts and property rights. Argentina's peso is not just money, it is the pulse of a nation's trust. And until that trust is rebuilt, crisis will remain the rule, not the exception. If you want to understand how money shapes wars, empires, and collapses, stay with us. Subscribe, and don't miss the next chapter of Wealth Wars.